Dual reality shock $1 trillion erased in 80 minutes. Silver down double digits. Headlines call it a bloodbath, yet physical premiums barely moved, and Eastern markets continued pricing silver several dollars above Western spot. That contradiction is where the real story begins. On the surface, the screen shows panic. Futures cascade lower, algorithms accelerate momentum, and volatility expands in seconds. Beneath the surface, vault reports show measured withdrawals, delivery interest remains intact, and regional spreads refuse to collapse, two realities operating simultaneously. This is the dual structure of modern metals markets, paper repricing versus physical flow. When velocity becomes extreme, it rarely signals randomness. It signals imbalance, liquidity thins, leverage compresses, and mechanical flows overwhelm marginal bids. Price becomes a function of positioning, not necessarily supply. Serious participants do not stop at candles. They monitor open interest against registered inventory. They watch spreads, roll windows, and delivery notices. Because in stress events, structure reveals itself. The question is not simply why price fell. The question is what actually moved underneath it. Event breakdown and immediate impact. The move itself was surgical in its speed. In roughly 80 minutes, silver dropped more than 10% from intraday highs, slicing through the 150-hour exponential moving average and collapsing below round number support that had held for weeks. Gold fell approximately 2% in the same window, translating into an estimated $1 trillion in combined precious metals market capitalization erased in little more than an hour. Western spot silver printed in the high 70s while front-month futures briefly diverged during peak volatility. Meanwhile, Shanghai pricing maintained a notable premium, signaling that regional demand dynamics were not collapsing in tandem with Western paper flows. Volatility metrics spiked sharply, and cross-asset correlations compressed toward 1. Equities sold off, the dollar index firmed, and energy held comparatively resilient. The magnitude was dramatic. The speed was more revealing. Markets do not reprice fundamentals this quickly without structural triggers. When liquidation unfolds inside an hour, it often reflects positioning unwind, margin compression, or forced de-risking rather than slow recalibration of supply and demand. Timing matters. The move occurred within proximity to roll activity and ahead of delivery cycle sensitivity, a period when leveraged structures are most fragile. In thin liquidity windows, narratives adjust instantly and flows dominate price discovery. This was not merely a decline. It was a stress event that exposed how leverage-heavy structures behave under pressure, which requires a closer examination of the plumbing beneath the headline numbers. Data stack and market plumbing. To understand whether this was panic or pressure, we move to the data that governs settlement, not sentiment. Open interest remained elevated relative to registered inventory. When total outstanding futures contracts represent multiples of the metal categorized as deliverable, scarcity math becomes relevant. Each contract represents a defined downs obligation. Registered inventory represents metal available for delivery. The ratio between them defines structural leverage embedded in the system. Eligible inventory, often misunderstood, reflects metal stored but not committed to delivery. It is owned but not necessarily available. Registered metal, by contrast, is designated and warrant ready. That ownership distinction matters during stress. If open interest rises while registered supply stagnates or declines, pressure does not appear immediately in price. It builds beneath it. Vault reports during the event showed continued movements rather than inflows that would signal easing tension. Delivery notices remained active, and standing for delivery into active months did not collapse in proportion to price. Spread behavior provided additional clues. The forward curve showed signs of flattening rather than expanding. Contango, a subtle signal that immediate supply was not flooding the market. Lease rates, where available, trended firm, suggesting the cost to borrow physical metal was not easing in line with price weakness. Volatility metrics confirmed that implied volatility expanded faster than realized movement initially, a classic signature of leveraged positioning adjusting to higher margin requirements. When volatility expands, exchanges raise collateral thresholds. That mechanical adjustment compresses leverage quickly. Positions are reduced not necessarily because conviction changes, but because margin models demand it. Public data sources such as commitment of traders reports, exchange warehouse disclosures, and daily vault updates provide transparent verification. They show positioning concentration, inventory classification, and warrant movement. This is not hidden information. It requires interpretation. Most market participants track momentum oscillators. Disciplined observers track warehouse stocks, delivery ratios, and spread compression. When price declines sharply but registered inventories do not meaningfully expand, a divergence forms. That divergence does not predict an outcome, it signals structural tension. During stress cycles, plumbing reveals fragility earlier than headlines. To understand why these divergences persist, we must examine how modern futures markets transmit pressure in the first place. Structural explanation layer. Disconnects between paper price and physical flow are not anomalies. They are embedded features of how modern futures markets function. A futures exchange exists primarily for price discovery and hedging. Producers hedge output, consumers hedge input costs. Speculators provide liquidity. The quoted price at any moment reflects the marginal trade executed under current liquidity conditions, not a census of total metal in vaults worldwide. During stable periods, that mechanism works efficiently. In stress cycles, the structure amplifies movement. Liquidity providers widen spreads. Algorithmic systems react to volatility inputs and cross-asset signals. When correlations compress and risk models recalibrate, flows accelerate mechanically. Price becomes highly sensitive. 2. Incremental order flow. Historical precedent reinforces this pattern. In prior growth scares, industrial metals consistently led downside moves. Silver, with significant industrial exposure, responds more aggressively than gold when growth expectations weaken. Gold functions primarily as a monetary asset and defensive hedge. Silver straddles both roles. In liquidation waves, the hierarchy tends to hold. Gold stabilizes first, silver overshoots, then broader industrial metals follow. What typically breaks first in these episodes is leverage, not supply. Margin requirements rise as volatility expands. Risk managers reduce gross exposure. Funds trim positions to meet collateral calls. None of these actions require a change in long-term thesis. They reflect balance sheet constraints. It is critical to understand that the futures price reflects the most recent trade under the tightest liquidity, not the aggregate state of above-ground inventory. Structural imbalance can exist for extended periods without forcing immediate resolution. Stress can persist while positioning adjusts. Mechanical triggers compound pressure. Exchange margin increases, volatility targeting strategies, and dollar strength cascades all feed into model-driven selling. When the dollar appreciates sharply, commodities priced in dollars face additional technical headwinds. Recognizing these mechanisms removes the need for dramatic explanations. The system is built to transmit stress quickly through leveraged layers. The more important question now is not whether stress exists, but when structural pressure points converge within the calendar cycle, countdown window. Stress events become more consequential when they intersect with the calendar. The delivery cycle imposes structure on behavior. First notice day marks the point when long contract holders must declare intent to take delivery or roll forward. The roll window compresses liquidity as participants shift exposure into the next active month. Settlement mechanics tighten attention around warrant availability and position concentration. Volatility expanding ahead of these windows alters positioning incentives. Traders who intended to roll may accelerate decisions. Short-term participants may reduce exposure rather than absorb higher margin requirements. Options positioning can amplify this effect. When implied volatility surges, gamma exposure forces hedging adjustments that mechanically influence futures flows. The next 2 to 3 weeks therefore carry structural sensitivity, not because a specific outcome is predetermined, but because timing compresses flexibility. Scarcity math becomes more visible near settlement. The ratio of open contracts to registered inventory matters most when delivery intentions crystallize. Short-term catalysts overlay this window. Scheduled macro data releases, Federal Reserve commentary, and geopolitical developments can shift dollar momentum or alter inflation expectations quickly. Those shifts feed directly into leveraged commodity positioning. Time does not guarantee resolution. It concentrates pressure. As we move through this window, plumbing interacts with broader macro forces, which ultimately determine whether stress dissipates or compounds. Macro overlay. No metals analysis is complete without placing the dollar at the center of the frame. Silver is priced globally in dollars. When the dollar index strengthens, commodities face mechanical pressure. A rising dollar tightens global liquidity, increases funding costs for non-US participants, and forces recalibration across risk models. Even without a change in physical demand, currency strength alone can suppress futures pricing. Federal Reserve positioning reinforces that backdrop. When rate expectations remain elevated or liquidity conditions tighten, leveraged exposure becomes more expensive to maintain. Higher real yields compete with non-yielding assets. Margin models incorporate volatility and funding costs simultaneously. This creates a feedback loop, where dollar strength and policy posture compound pressure on metals positioning. Oil and geopolitical instability introduce a countercurrent. Energy shocks carry inflationary undertones. Supply disruptions or regional conflict risk can revive safe haven demand and increase long-term hedging flows. Sovereign and central bank gold accumulation trends demonstrate that official sector participants continue diversifying. Reserves independent of short-term volatility. These cross-currents create tension. Liquidity tightening suppresses price, while inflation hedging demand supports it. Macro forces do not override market plumbing, they amplify or suppress existing structural pressure. Globally, divergence persists. Eastern markets often emphasize physical accumulation, while Western markets remain derivative-heavy. Understanding which force dominates requires scenario framing rather than ideology. Structured bull case. The constructive case does not begin with price targets. It begins with conditions. If delivery ratios tighten as first notice day approaches, the leverage embedded in open interest becomes more visible. A high contracts to registered supply ratio does not guarantee disruption, but it increases sensitivity to incremental demand. If dollar momentum stalls or reverses, mechanical headwinds ease. Metals historically respond quickly when currency pressure fades, should the forward curve flatten further or shift toward backwardation. It would indicate immediate demand strengthening relative to deferred supply. That structural shift carries more weight than a short-term technical bounce. Persistent vault withdrawals during price weakness would reinforce the divergence between paper repricing and physical behavior. If volatility compresses following liquidation, margin pressure relaxes and forced selling subsides, allowing positioning to rebuild. These are probability layers, not certainty claims. Scarcity math functions as a long-term tailwind when leverage meets finite deliverable supply. Acceleration requires alignment of these factors. The data will signal it before headlines do. Structured bear case. The downside case must be treated with equal seriousness. If the dollar index continues breaking higher, mechanical pressure on commodities intensifies, a sustained currency breakout tightens global liquidity and reinforces model-driven selling across asset classes. Liquidity compression across commodities would likely extend beyond silver alone. If hedge fund positioning continues to unwind, long liquidation can persist longer than fundamentals justify. Stress cycles frequently overshoot equilibrium because leverage reduction is nonlinear. Positions are reduced until balance sheets stabilize, not until value appears attractive. Mining equities provide another signal. If producers and developers fail to respond constructively while physical metrics tighten, it reflects institutional skepticism about near-term pricing recovery. Widening contango in the futures curve would indicate reduced urgency for immediate delivery and reinforce short-term softness. These risks are real and measurable. Structural imbalance does not eliminate drawdown potential. Discipline requires acknowledging that markets can remain pressured while adjustment unfolds. Ideology does not protect capital. Data does. Data recap compression. 1 trillion erased in 80 minutes. Silver fell double digits. Open interest remains elevated against limited registered supply. Vault withdrawals continue. Eastern premiums diverge from Western pricing. Volatility expanded into a sensitive delivery window. The dollar challenges recent highs, reinforcing mechanical pressure across. Leveraged commodity positioning, disciplined close. Study structure. Verify data. Manage risk precisely. Logic over leverage. Education over emotion, always.